Interest rates and inflation. What is the relationship? So a few of you have been asking for this video to come out, and I thought let's just deep dive around what interest rates are, what inflation is, how it actually works together, and ultimately, is it good or bad? And I'm going to give you a bit of a warning. It's some bloody bad news for the country over the next 6 to 12 months, but it does create a window of opportunity. First off, what is inflation? Inflation in itself isn't good or bad. When there's too much inflation, it's bad. When there's too little inflation, it's bad as well. Ultimately, the way you should see it is demand and growth of demand. Inflation is when things cost more, so it's the devaluation of money. Let's think of a pot of Pringles, for example. If you remember as a kid, I'll say it was £1, making up the price. You have you have several types of inflation, but I'll talk about the two most common. If you remember a packet of Pringles 10 years ago, when you opened it, it would be filled to the brim, right? And absolutely open it, pops out everything. Nowadays, if you open a pot of Pringles, the first like maybe a few inches at the top is going to be air, and it's all packaged in. That is called shrinkflation, i.e. when a producer produces something, they don't want to make it too expensive where you're like, I'm going to stop buying that. So instead they put it in the same size packaging, but shrink the actual amount. And you would have seen that with any packet of crisps, maybe biscuits or something like that. So that is shrinkflation. The other is inflation through pricing. So ultimately something that would have cost you £1 last year might be £1.10. So that's had 10% inflation. So what causes inflation? Well, inflation ultimately is when people are spending too much in relation to the supply. And this happened a lot through COVID. How did this happen? Well, think logically. The supply chains got ruined through COVID because everything locked down for a good few months, and that's our country. But you have to bear in mind, we import a lot of things, i.e. we rely on other countries giving us their goods in order to facilitate the demand we have. So we shut down for 3 months. Obviously, every country was slightly different, but ultimately, pretty much the whole world shut down for 3 months, okay, because everyone was under pressure to do so. But that demand didn't really go away. And then, of course, the government decided, which I think was good but could have done with more regulation, the government then decided we need to keep the business going, we need to keep the wheels churning. So then they threw money at businesses. Some of it really well, some of it really bloody stupid. And I'm going to tell you one called BBills. So BBills was a government grant, basically. You pay something like 2% on it. You don't need to sign any personal guarantee, so you're not personally liable. And as long as you had an existing limited business, you could borrow up to £50,000. The idea of it was to keep the business running and spend, etc. However, genuinely, I know people that had like 1 legitimate business and 8 limited companies. And so, as long as you said, yeah, I think I will make 200,000 in the next 12 months, you would get £50,000 like that. And I got loads of BBills out, by the way, being open about it, and I did genuinely use it for the investment of my business. I know people that got £500,000, and people just bought iPads, Macs, all over the place. Just spend. Because naturally, most people's mentality is, if you give them access to money, they will spend it. And then you think, on top of that, you'd have a load of people on furlough, and maybe you're one of them. But again, think logically. You pretty much got paid almost the exact same amount of money to not work. Well, what do you do when you still got your money, but no time spent on anything worthwhile? Some people used it as an opportunity. Others would be getting more takeaways and all of that. And then, of course, you got into the habit of takeaways because of the vouchers and everything, all of that stuff. So I'm not saying it was right or wrong, but just to explain what happened is the supply chains were ruined. So supply went there, demand was up here, and now inflation went through the roof. It was in the teens, right? So that's what inflation is. It's an impact of lack of supply and over demand. And so inflation, just so you've got an idea, in the UK, the target inflation is about 2% right now, and we are nowhere near that. We're like 3.5, 4 times that. I think we're about 7%, and I say 7% because the official figures are way worse than that. But that's inflation. Now, we don't choose what inflation is, we just measure it. Okay, important to understand that. We don't go, right, we're going to have 5% inflation this year. We're targeted at 2%, but in general, we're just nowhere near there. However, interest rates are a reaction to inflation. And the idea through monetary policy is we control the interest rates from the Bank of England. Other countries do it through their central banks, where we dictate what the interest rate's going to be. And that impacts inflation. Okay, how does it impact it? Well, think about it logically. When interest rates go up, it decreases spending. And it does that in two ways. Number one, what happens is people stop buying things. So companies, let's say I wanted to expand across 3 locations this year. And in order to do that, I would need to borrow a couple of £1 million. You think, okay, cool. That's what a business does, by the way, when they want to grow. Typically, they take borrowings. So if it would cost me 3% to borrow £2 million, okay, not too big of a deal. That's going to cost me £60,000 a year to borrow that 2 million. And frankly, as a business owner, if you can't make 60 grand a year from £2 million, you shouldn't be in business, right? However, now, let's say the direct interest rates, and by the way, I'm not talking about the base rate, which is Bank of England, the actual interest rates is going to cost to borrow because the banks need to put their margin on top. Let's say it would now cost me 8% a year. So now that 8% a year is going to cost me £160,000. So in order for me to expand, it's costing me £100,000 more. Let me give you another example. The bedrock of the UK is the property industry. If you were to get a mortgage, and I'll give my house as an example. So my house has about a 290k mortgage on it. I spend about 1,300 a month on my mortgage, give or take. As of end of January, start of February, I'm coming up to the end of my fixed term. Great news, all right? So what do you think I'm going to be paying? It's going to be almost double that. So my 1,300 monthly payment is going to come across up to £2,600. So what? So you have to think that causes a lot of damage. So either I'm going to have to sell my house or I'm going to have to cut down my spending dramatically. So that's one way it does it. The other way is, of course, it becomes more appealing to keep money in the bank. Because if you're going to get 5% on your money, risk-free, just by keeping it at the bank, suddenly it becomes quite appealing to do that. So interest rate is deliberately controlled and increased to stop people spending so that inflation comes up. And as you can see here, and I'll talk through it, interest rates have been consistently coming up at 0.5%, 0.75%, 0.5%, 0.25%, and then it stayed the same, which is a very good indication in the last one. And as you can see, in general, inflation has been bloody stubborn, but has been coming down bit by bit. And right now it's at around 7%, just shy of that. So what's my prediction of what's going to happen? So I believe there's probably one more interest rate increase coming our way. I'll be honest, as painful as it is, I would have had one more interest rate hike. And the reason for this is I think that would have nailed it home. I think that would have been a real, like, boom, one final one to kill people, break it down and bring down that inflation. And I think that would have been the final nail in the coffin. I do think we're due one more increase. Whether that's going to happen soon, in a few months or something, I reckon there will be one. I think the interest rates will have to hold at that for at least another 6 months. I genuinely believe it will be at least another 6 months, which is good and bad, by the way. I'm going to talk about the opportunity and what it's actually going to cause. The reason for that is the inflation is being really stubborn right now. It's not going down. And by the way, you're to blame for that, as am I. Basically, we're bitching and moaning about how hard times are, and yet we're still spending as a country at an unprecedented level. So if it's really that hard, why are we still going out to the cinema, getting meals in all the bloody time, all of these sort of things that we don't consider as a luxury anymore? Food, let's say your lunch at work. Almost everyone used to make a sandwich at home and bring it in. Nowadays, pretty much everyone I know will be spending money on getting their lunches, and it's like, that is a luxury. So I think what will happen is it's still going to be very resilient. We're a very, 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 very strong country. Do I think there's going to be a dip in the overall market? Yes. But do I think it's going to be... You see all of these bloody articles going around like 40% drops, could crash, this could be the big crash, this is going to be the worst ever thing going on. No, there is absolutely no economic indicators that that would happen. We are still flush with cash. We've got people working and going through. Okay, it's just not going to happen. And I will eat my hat. If it genuinely crashes by 20%, I will hang up my hat and quit the channel. It's not going to happen. It's not going to happen. I feel very confident on that. So what do I think will happen? I think we might see a 1 to 4% drop. Okay, and that, by the way, is not a big deal at all. But there are going to be consequences, and I'll talk through why I think this is. So it has to stay consistent in order to drop, and the other increase might go up to push inflation faster down to that net 2% that we're looking to achieve. And it's going to take 6 to 12 months to actually get there. So what's going to be the impact? Well, first of all, Frankenstein businesses. What do I mean by Frankenstein businesses? I mean like Wilkinson's. You may have heard the news recently about Wilkinson's going pop. Being blunt about it, it needed to happen. Okay, it was an outdated model, and there's plenty of others that will follow. These companies are basically companies that shouldn't even exist. Their model is terrible. It used to make sense. They had no competition. They're in prime locations, charging pennies for things where other shops are charging pounds for them, you know, all of that sort of thing. We're going to see more and more of those. We're going to see tens of thousands of jobs and redundancies happening across the board. Now, you might think, oh my God, this is terrible. To give you an idea, right now there are 900,000 vacancies. What that means is there are 900,000 jobs where we're trying to fill them as a country, and we don't have anywhere near enough people looking for those jobs. So even if it came down another 100,000, 200,000, where people got made redundant, it's really not going to impact the country as a whole. So do I believe that this is going to be people losing their houses, all of that sort of thing? No, I don't. I don't think it's that sort of thing at all. I'd be genuinely shocked. If you work for one of those Frankenstein businesses, probably worth looking, right? Because those businesses aren't going to be around for, and they shouldn't be, by the way. Like, it sounds horrible, but welcome to capitalism. They shouldn't be there. But that's definitely going to happen. Loads more redundancies across the board. A lot of people will be losing their jobs. And if people aren't managing their money correctly, people are going to lose their houses as well. Because interest rates, we've had 700,000 come off of fixed interest rates this year, where people have fixed them from 5 years ago at really low rates. We're going to have another 700,000 this year. That is going to have an impact that will lead to a lot more people selling and a lot less people purchasing property. So you might go, this is all doom and gloom. This is horrible, right? No, it needs to happen. This is just the economy. It's not that big of a shock. So I am baffled why people think it's a big shock. It's fully predictable. Okay, you could have seen this coming quite easily. Now, is it bad? No, it's actually a massive opportunity. And by the way, articles like I was talking about, like the 40% drop, fucking ignore them, okay? That's just people selling fear. Why do papers sell fear? Because it sells the papers. If they went, oh, by the way, this has happened, and by the way, it's probably not going to impact us too much, you're not going to go, oh, I need to read that article, are you? It just doesn't work like that. It's just marketing. If in doubt, zoom out and watch the big players. What are all of the banks doing now? Buying property. What are the insurance companies doing now? Buying property. What are pension companies doing right now? Buying property. It doesn't take a genius, but you want to listen to Knock Off Nigel Down the Pub or the Daily Mirror. All right, it's not going to happen if you're following that advice. So what is the window of opportunity? Let's go back a few years where everyone was hyped and buying all the property. Buy, 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 go, 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 go. Everyone was happy paying 15, 20, 30, some cases £50,000 above market value. If I said to you, hey, I'll give you a 6-month window where you can buy in the best locations that you couldn't get to before because they were getting snapped up too fast. I'm going to give you a 6-month window where the competition for buying is really, really low. Would you snap my arm off? The answer is yes. But that's the situation we're in now with interest rates higher because we need to drive down this inflation, making it harder with redundancies going up, job loss is going to go up, unemployment is going to go up. This is an opportunity, and I know it sounds horrible because it kind of sounds like ambulance chasing, isn't it? But this is capitalism. Now is the time to attack, not be reactive to it. So this is the opportunity. Yes, your cash flow is going to get destroyed right now. It is. But if you've got 100K to invest in property, cash flow is not your problem. You've got a capital preservation problem or a capital growth problem. So this is about protecting your money. So I would definitely be investing in the best areas right now. Get hold of 1 or 2 properties. Get your money working hard for you, because just think for yourself. What do you think happens when interest rates come back down? So let's say 6 months from now, 12 months from now, interest rates come down to the 2 to 3% mark. We've got stable inflation. What do you think happens for people buying properties? If you guessed, I don't think it takes a genius, that a load more people are suddenly going to start buying again because finance is cheap again, you would be right. And if you don't believe me, look at the last 1,000 years for evidence. Okay, this isn't like over-optimistic, it's not being delusional, this is just the reality of how economics works, and it's highly predictable through thousands and thousands of years. So yes, it's going to be hard. Yes, people are going to get made redundant. Yes, some people are going to lose their houses. But if you have got a steady job that's not in an old Frankenstein business, you are ready to take the leap and invest in yourself, this is the window of opportunity. You've got 3 to 6 months. I'd say 6 months in total, but that means you need to attack now because you've got the conveyancing process. And by the way, yes, I've got a vested interest. I'm invested in property. I do that for my investors, but I am buying 3 to 5 properties every single month. I am not slowing down. If anything, I want to use this opportunity to get access to better and better areas. Do I care about discounts? Not really in the grand scheme of things. I'm looking for the 10, 15, 20-year capital growth. By the way, if you're watching this and you've got 100K to invest and you want me to build your portfolio for you, put APG in the comments. I'll put a link, pin it to the top, fill in your details, and we will do a free one-to-one strategy session. We'll make sure you've got the funds to invest and everything like that, of course, but ultimately we'll find out where you're at, where you want to get to, and if we can genuinely help you on that journey, then we will help you achieve that. Put APG in the comments. Hey, this is a bit out there of a video for me, a bit ranty at the end of it, but ultimately interest rates and inflation are intrinsically linked. If there's anything you want me to explain more, let me know in the comments and I'll try to reply to as many as possible. But ultimately, I like the old Warren Buffett quote where it's be greedy whilst others are fearful and fearful whilst others are greedy. And right now people are not greedy, they are fearful, and this is your time to think disruptively, attack the market and take advantage of this, because I promise you it will not be around forever. When property prices are at their highest, which they were 2 years ago, it really could only go one way. And now that we're here, now's the time to take advantage before it spikes back up. So as I said, put APG in the comments. Let me know what you thought of this video. And by the way, if you are new to this channel or you haven't subscribed yet, only 50% of people are subscribed to watch these videos. Do yourself a favor, make sure to hit that subscribe and notification bell so you're kept up to date with the latest tips, tricks, and techniques in the property investment world. And of course, if you did get value, just hit that like button and I'll see you in the next video.